The US unemployment rate rose to 4.3%, touching an all-time high since October 2021. This similar high rate was noticed just before the COVID-19 pandemic in March 2020, when it was at 4.4%. The S&P 500, the top 500 US companies constituent index, has been down by more than 8% since July 15, 2024. These two, along with the looming issues in the housing sector, are raising serious concerns among global investors who are now anticipating that US heading towards recession. But are these few factors fair enough to conclude that the recession is ahead? Before we conclude, let us examine other factors and indicators in this video. Hi, welcome to PSI, Plan, Save and Invest. Is the US economy heading towards recession? This question itself tells us that the US is not currently in recession. So let us examine which phase of the economic cycle the USA is currently facing. Look at the economic cycle of a country. You can see the three phases: expansion, peak and contraction. So these are common across all the countries. So any country which is at expansion phase should go through peak phase and then contraction phase as well. Once the contraction phase is completed, then again expansion phase. So this is a cycle. That's why we call it as an economic cycle. In the economic cycle, here we look for two well-known indicators to anticipate in which phase currently USA economy is facing. One is GDP growth rate and the second is inflation rate. Look at the GDP growth rate. We can see that from past 2 quarters, the GDP growth rate is decelerating. But the current quarter, USA declared a good number in accelerating GDP. The second one, the inflation rate has consistently decelerating from past few months. Considering the decelerating GDP and accelerating inflation and looking at the economic cycle phase, we can conclude that currently USA is the economy is at peak phase. So this statement suggests that US economy is at peak phase. Before just looking at these two indicators, let us observe the S&P 500 monthly chart as well. If you see on July 15th, 2024, S&P 500 formed all-time high, followed by a large bull cycle from November 2022. Now we have clarity on the economic phase of the USA, which is at its peak and is followed by contraction or recession. Now, post-peak, definitely the economy, either it should go through slowdown, contraction or recession. But how bad the slowdown or contraction or recession will be dependent on other factors as well. But now let us stick to our point. So generally every country economy goes through 3 phases as per economic cycle: expansion, peak and contraction. Now we have concluded that the next economic phase of the USA is contraction. First it will be slowdown, then it gets contracted. And that could even be a recession. How bad the contraction is dependent on the situation. Now we can't predict, it could be a deep recession or general slowdown or general contraction. But now the current question to the investor like us is, when USA is going to face the contraction and will it be only contraction or recession? So the timing is important. To predict this time factor, we have to look for economic turning point indicators. And these indicators are categorized as 3. Number 1, leading indicators. Number 2, coincident indicators. And number 3, lagging indicators. For this question, is there USA economy is heading towards recession, we have to observe only leading indicators because currently it is not in the recession. We are anticipating the recession. So how do we anticipate upcoming phase is by observing the leading indicators. Considering the current economic peak in the USA, we now look for when the phase will turn to contraction. In this instance, we will look only for leading indicators. Let us examine the leading indicators first. What are the leading indicators? These indicators tell us the change in the phase of economic activity at least 1 year to several months before the actual turning point. Now you should be able to understand that these indicators will tell us at least 1 year or several months before when the economic activity is going to turn around. These indicators includes unemployment claims, market indices like observing S&P 500, Dow Jones, the inverted yield curves. Consider it as an yield curve. Coming to unemployment claims, This is the number of employees who are jobless and claiming unemployment insurance in the USA. This indicator indicates an immense rise in USA initial jobless claim. Look at the graph taken from the tradingeconomics.com. It is higher than the COVID-19 pandemic. If we observe the unemployment rate, which is also at its peak and precisely equal to the rate at the time of COVID-19 pandemic, that is 4.3%. Currently, the unemployment rate of USA is 4.3%, which is all-time high since October 2021, and which is also equal to March 2020 number, that is 4.4%, just before the COVID-19 pandemic. So this unemployment indicators confirm that economy will turn to contraction in a year or within several months. Let us examine other indicators. Now let us look at the stock market indices. If we observe the S&P 500 weekly chart, we can clearly see that the market corrected more than 8%. It also formed three black crow candlestick pattern indicating trend reversal as per technical analysis. As the current fall in the S&P 500 indicates a pause to the bull market, and if it is followed by a bear market, we can conclude that these market indices, which are primary leading indicators confirming the contraction in the economy in the near future, probably within a year. So the third factor, yield curve. An inverted yield curve will form if short-term lending rates are higher than long-term lending rates. In normal conditions, long-term interest rates must be higher than short-term interest rates because the more extended lending periods has a higher risk or a default risk. So generally, short-term interest rates are lower than long-term interest rates. Suppose if I am lending 1 lakh rupees to my friend for 1 month, probably I might charge 1% or 2%. But if I am lending the same 1 lakh rupees to my friend for at 1 year, then probably I might charge 15% to 20%. So generally long-term interest rates are higher than short-term interest rates because the longer period carries default risk. Now let us look at the standard yield curve and inverted yield curve before we observe the USA yield curve. Regular and standard yield curve looks like this, and the inverted yield curve looks like this. Now the current USA yield curve, as per our observation, the yield curve is inverted. The yield or the interest rates for longer maturity bonds is lesser than shorter period bonds. If you observe 30-year maturity bond, which is at 4.3%, compared to 6 months maturity bond, which is at 5.36%. This indicates long-term uncertainty and pending for recession as per economic theory. Examining the three leading indicators, we can now conclude that US economy is turning towards slowdown, contraction or recession. Let me conclude this. We try to explain how to predict the slowdown in the economy using various indicators. This video covers only the primary leading indicators, but we will examine and explain other indicators in our upcoming video. Yes, the leading indicators of the economic phase turning point indicate that US economy is heading towards a recession, probably within a year, probably late 2025 or early 2026. Other coincident indicators like industrial production, manufacturing PMI, service PMI, these indicators we can examine post turning point. Then we can analyze how bad is the slowdown, or whether how bad is the recession, how bad is the contraction. I hope you enjoyed the content. If you like the content, please like the video, subscribe to our channel, and if you have any questions or feedback, please comment in the comment section. Thanks for watching the video.